Professional traders are not always trading. In fact, most of the time they are waiting. Waiting for the right price level, waiting for confirmation, waiting for risk to be clearly defined, because they understand something beginners often ignore. Every trade is a risk decision, not just a profit opportunity. When your capital is small, patience becomes your biggest advantage. One good trade is far more powerful than 10 random trades. One controlled loss is far safer than one emotional mistake. Now, let's talk about another key rule that can completely change your trading journey. Always use a stop loss. Always. This is non-negotiable. A stop loss is not a sign of weakness. It's a sign of professionalism. It is simply the price where you accept that the trade idea is wrong. Nothing more. Nothing personal. Just business. Without a stop loss, one bad trade can destroy weeks or months of careful progress, especially with a small account. Think of risk management like a seatbelt in a car. You don't wear it because you expect to crash. You wear it because if something goes wrong, you stay protected. Now, here's another powerful habit that small capital traders must develop. Track every single trade. Write down why you entered, where your stop loss was, how much you risked. It happened emotionally. What you learn, this turns trading into a skill-building process instead of gambling. Over time, patterns appear. You discover what works and what doesn't. That self-awareness is what builds consistency. And consistency is what grows small accounts into large ones. Let's talk about expectations for a moment, because this is where many beginners go wrong. If you start with $100 and expect to make $50 every day, you will take dangerous risks. You will overtrade, you will force setups, and eventually, the account disappears. But if you start with $100 and focus on learning to trade properly, controlling risk, staying disciplined, then even slow growth becomes meaningful. Because the real goal is not just growing one small account. The real goal is becoming the kind of trader who can grow any account. Once you develop discipline, risk control, and emotional stability, capital becomes a tool, not a limitation. Now let me summarize the most important principles for trading Forex with small capital. First, protect your money before trying to grow it. Survival comes first. Second, risk only a small percentage per trade to 1% is a powerful rule. Third, use small position sizes like micro lots. Fourth, trade less, but trade better. Quality over quantity. Fifth, always use a stop loss. Sixth, track and review every trade. And finally, be patient. Skill grows before profit grows. If you truly understand these principles, small capital stops being a weakness. It becomes your training ground, your discipline builder, your foundation. Remember, every professional trader you admire today was once a beginner, staring at a small account, wondering if growth was possible. It is possible, but only for traders who respect risk, control emotions, and stay consistent. So, if you're starting small, don't rush, don't compare, don't chase fast money. Trade smart, protect capital, build skill, and let time do the rest. If you found this helpful and want to keep learning simple, practical Forex strategies that actually work in real life, make sure you like this video and subscribe. And tell me in the comments, what size account are you starting with right now? I'll see you in the next video.